This is a search query. 11 words typed into a Google search bar at 3:47 a.m. Pacific Time on January 23, 2026, by a researcher at Stanford's Institute for Human-Centered Artificial Intelligence. Gemini Financial System Stress Prediction Accuracy Historical. The researcher wasn't looking for investment advice. She was auditing Google's AI prediction capabilities for an academic paper on machine learning reliability. The query was routine. The response was not. Gemini, Google's most advanced AI system, the model that powers their enterprise analytics and institutional research tools, returned a result that wasn't supposed to be visible to public queries. A fragment of internal analysis, cached incorrectly, exposed for approximately 47 minutes before Google systems detected the leak and removed the content. The fragment was screenshotted. The screenshot was shared. Within 72 hours, it had circulated through hedge fund networks, institutional research desks, and the small community of analysts who track AI-generated market predictions. The fragment contained a single data table. The table showed Gemini's confidence levels for various market scenarios across Q1, Q2, 2026. Most scenarios showed typical probability distributions. 30% chance of this, 25% chance of that, the bell curves that AI systems normally produce. One line was different. One scenario showed a probability that AI systems almost never generate, because the training data rarely supports such certainty. The scenario: systemic financial market dislocation event, loss exceeding 40% across major indices within 60-day window. The probability: 94.7%. 94.7% confidence in a market crash exceeding 40% within the next 60 days. Not a possibility, not a risk factor. Near certainty, according to the most sophisticated prediction system ever built, trained on more financial data than any human analyst could process in 1,000 lifetimes. The screenshot is real, the analysis is internal, and what Google's AI sees coming, what it calculated with 94.7% confidence, is now the most closely guarded data point in global finance. Here's what they're not telling you. Google's Gemini isn't a chatbot. The consumer version you interact with is a fraction of the system's capability, deliberately limited to avoid exactly the kind of leak that occurred on January 23rd. The full Gemini system runs on Google's internal infrastructure, processing data feeds that no public AI has access to, real-time transaction flows across Google Pay and Google Wallet, aggregate search query patterns showing what millions of people are worried about, Gmail metadata revealing corporate communication patterns, Google Cloud data showing enterprise resource allocation, and YouTube engagement metrics indicating where attention is flowing. This data doesn't just describe the economy, it predicts behavior before behavior manifests in traditional metrics. When people start searching for recession preparation before any recession is announced, the AI sees it. When corporate emails shift from expansion language to cost-cutting language, the AI detects the pattern. When payment flows slow before any official data shows the slowdown, the AI measures it. The 94.7% confidence level emerged from this data, patterns that traditional financial analysis cannot see because the data feeds don't exist outside Google's infrastructure. At 11:15 a.m. Eastern on January 24th, a hedge fund managing $47 billion in assets executed what their prime broker described as the most aggressive de-risking we've seen since March 2020. The fund liquidated 73% of their equity positions in a single session. Their explanation to investors? Proprietary signals indicate elevated probability of near-term systemic stress. The fund's chief investment officer sits on an advisory board that receives Google's institutional research products. The proprietary signals language is hedge fund speak for, "We saw something we can't discuss publicly." 3 other funds with similar Google advisory relationships executed comparable de-risking between January 24th and January 27th. Combined liquidation: approximately $31 billion in equity positions converted to cash and short-dated treasury bills. The selling wasn't random profit-taking. The selling was coordinated response to information that circulated through a small network of institutions with access to Google's analytical infrastructure. The public wasn't told. The retail investors whose pension funds compete against these hedge funds weren't informed. The asymmetry of information that always exists between institutions and individuals widened into a chasm. A 94.7% confidence prediction shared among the connected, while the unconnected continued buying the market the connected were selling. This is where the lie becomes unsustainable. The paper financial system operates on a foundational assumption that market prices reflect available information, and that information is roughly symmetrically distributed. Insiders might have advantages, but the basic structure of public markets means analysis flows eventually to everyone. AI prediction systems destroy this assumption. When Google's Gemini calculates 94.7% probability of market collapse, that calculation incorporates information that cannot be replicated by any other analyst. The data is proprietary. The processing power is unavailable elsewhere. The pattern recognition exceeds human cognitive capacity by orders of magnitude. The paper versus physical distinction takes on new meaning in an AI-predicted meltdown. Paper assets, stocks, bonds, derivatives, anything that exists as ledger entries in financial systems, are precisely what the AI predicts will lose 40% or more. These assets depend on counterparty performance, market functioning, and institutional stability. A systemic dislocation event disrupts all three. Physical assets, gold, silver, Bitcoin, and self-custody, tangible goods that exist independent of financial system functioning, are what the AI's prediction implicitly recommends. Not because the AI has opinions about gold, but because the scenario it predicts with 94.7% confidence is specifically a scenario where paper claims fail to perform. The fragment that leaked didn't include Gemini's reasoning, the intermediate steps that produced 94.7% confidence. But the scenario definition itself reveals the mechanism. Systemic dislocation means multiple systems failing simultaneously. 60-day window means the timeline is imminent. 40% loss across major indices means the failure is comprehensive rather than sector-specific. The AI isn't predicting a bear market, it's predicting coordinated system failure. The kind of failure where claims on assets diverge from assets themselves, where what you thought you owned and what you actually own become different things. The distinction between paper wealth and physical wealth has never mattered more. A brokerage statement showing $500,000 in equity positions becomes $300,000 in the 40% scenario. But the loss might be worse than 40% if the systems for accessing and transferring that wealth fail during the dislocation. Physical gold in a safe retains its weight during any market scenario. Self-custodied Bitcoin remains accessible regardless of exchange function. Cash in hand doesn't depend on bank solvency. The AI's prediction doesn't discriminate between asset classes. It predicts systemic dislocation affecting major indices. But the implication is clear. Assets dependent on system function face the risk. Assets independent of system function don't. When institutions do what they're doing now, they're not hedging. They're acting on information asymmetry they know is unfair, but cannot resist exploiting. At 2:30 p.m. Eastern on January 26th, Alphabet Inc., Google's parent company, filed a Form 4 with the SEC disclosing insider sales. The filing showed that 3 senior executives in Google's AI division sold shares worth a combined $47.8 million during the week ending January 24th. The sales were executed under 10b5-1 plans, pre-scheduled trading programs that theoretically insulate executives from insider trading liability. But 10b5-1 plans can be established and modified with minimal notice. The sales occurred within 72 hours of the Gemini leak. The executives sold at prices near all-time highs, converting paper Alphabet shares to cash, while their own AI system was calculating 94.7% probability of market collapse. The executives aren't talking. The Form 4 filings don't require explanation. The timing speaks for itself. Google's AI division leadership converted equity to cash immediately after their system's prediction leaked to a small network of connected institutions. The selling extended beyond Google. At 4:15 p.m. Eastern on January 27th, meta-analysis of SEC filings revealed unusual insider selling across the technology sector. The ratio of insider sales to insider purchases reached 147-1 for the week ending January 24th, the most extreme reading since the week before the March 2020 COVID crash. Corporate insiders don't coordinate their selling publicly, but they operate in overlapping networks. They sit on shared boards. They attend the same conferences. When one executive acts on information, others observe and draw conclusions. The 147-1 ratio is the institutional community telling you what they believe without telling you what they believe. They're selling. Their AI systems are predicting something. The retail investor watching CNBC hears about buying opportunities while insiders exit at the fastest pace in 4 years. Less than 55 days remain within the 60-day window that Gemini's prediction specified. The window began January 23rd, the date of the leak, and extends through late March. Whatever the AI predicts is coming, it's coming within this window. The countdown is not public. Google has not confirmed the prediction. The company's official position is that the leaked fragment was test data not representative of production systems. But the institutional selling that followed the leak tells a different story. Test data doesn't trigger $31 billion in hedge fund de-risking. Test data doesn't produce 147-to-1 insider selling ratios. The response to the prediction validates the prediction's existence. The institutions that saw the fragment acted immediately. Their actions are visible in market data for anyone who knows what to look for. While American institutions sell, the BRICS bloc accelerates its timeline. At 9 a.m. Moscow time on January 28, 1 a.m. Eastern, the Russian news agency TASS reported that the BRICS payment system pilot had been advanced to immediate deployment status, following assessment of near-term risks to dollar-denominated settlement infrastructure. The language is diplomatic, but the meaning is clear. BRICS is accelerating its alternative financial system because they anticipate problems with the existing system. The near-term risks they assessed align suspiciously well with the timeline Gemini specified. China's response arrived hours later. The People's Bank of China published guidance requiring domestic institutions to stress test settlement capabilities under scenarios of external financial system disruption. The guidance specified a 60-day testing period, matching exactly the window in Gemini's prediction. The BRICS nations don't have access to Google's internal AI systems, but they have their own intelligence capabilities. They have access to the same underlying data, transaction flows, communication patterns, behavioral signals, through their own platforms and analysis systems. Multiple AI systems, trained on overlapping data, are reaching similar conclusions. Google's Gemini predicts systemic dislocation with 94.7% confidence. China's response suggests their systems see something similar. Russia's accelerated timeline implies comparable assessment. The convergence across geopolitical rivals is more significant than any single prediction. When American AI and Chinese analysis and Russian intelligence all point toward the same near-term scenario, the scenario becomes more probable, not because any single source is authoritative, but because independent analyses are confirming each other. The gold flows that have defined the past year's precious metals market take on new significance in this context. China's accelerated accumulation, now exceeding 50 tons monthly, positions the nation for exactly the scenario Gemini predicts. Physical gold held in sovereign vaults performs regardless of what happens to dollar-denominated financial markets. Russia's gold reserves, over 2,350 tons, provide similar insulation. The BRICS gold-backed settlement system under development offers an alternative infrastructure that functions if dollar-based systems don't. The Eastern Bloc isn't just positioning for a market decline, they're positioning for system failure, building parallel infrastructure that operates independently of the systems that Gemini predicts will dislocate. This is what a system looks like when it runs out of time. The AI's 94.7% confidence emerges from patterns that no human analyst can fully articulate, but we can identify the visible stresses that would contribute to such a prediction. The $15.4 trillion derivative expiration on February 14th creates concentrated settlement risk that clearinghouses have acknowledged exceeds stress test parameters. The COMEX delivery failures emerging from 287,000 contracts standing for physical gold create commodity market stress that ripples through connected positions. The LBMA settlement breakdowns and paper physical divergence exceeding 30% create precious metals dysfunction that affects collateral values across the financial system. The banking system stress visible in credit default swap spreads, widening since the UBS resolution, creates uncertainty about counterparty performance. The Treasury option failures, 2 in 2 months, create doubt about government debt market function. Each stress alone might not trigger systemic dislocation, but an AI system sees the connections between stresses. It sees how derivative failures cascade into commodity failures, cascade into banking stress, cascades into sovereign debt problems. It sees the network of connections that human analysis struggles to map. The 94.7% confidence emerges from this network analysis, not from any single data point, but from the interaction of dozens of stress signals that, combined, produce probability mass in the systemic dislocation scenario that the model was trained to identify. The trap has no exit that preserves current positioning. If Gemini's prediction proves accurate, paper assets lose 40% or more. If the prediction proves inaccurate, if the 5.3% probability scenario occurs, paper assets probably appreciate as the feared event doesn't materialize. The asymmetry of outcomes is severe. The upside from holding paper through a non-event is modest. Markets are already near highs. The downside from holding paper through a 40% crash is devastating, wealth destruction that takes years to recover. The expected value calculation favors de-risking. Even if you assign lower probability than Gemini's 94.7%, the magnitude of the adverse outcome justifies defensive positioning. The institutions that saw the prediction made this calculation immediately. They're not 100% certain the crash comes. They're calculating that the risk-reward ratio favors cash, short-duration bonds, and physical assets over equity exposure at current levels. The calculation doesn't require believing an AI is infallible. It requires recognizing that an AI with unprecedented data access is assigning near certainty to an adverse outcome, and that the downside of being exposed if the AI is right dramatically exceeds the upside of being exposed if the AI is wrong. The question is not whether Google's AI prediction is definitely correct. The question is whether your positioning reflects the possibility that it might be correct. The institutions repositioned, the insiders sold, the BRICS block accelerated. The connected world is acting on information you weren't supposed to see. The fragment that leaked for 47 minutes revealed what the most sophisticated prediction system ever built calculates about the next 60 days. That calculation is 94.7% confident in outcomes that destroy paper wealth. Those who saw the fragment, or who observed the behavior of those who saw it, are positioning in physical assets, cash, and structures independent of the systems the AI predicts will fail. Those who didn't see the fragment, who continue operating on the assumption that markets will function normally because markets usually function normally, face the possibility that this time is different, that the patterns the AI detected are real, that 94.7% confidence means what it says. Reality asserts itself through prediction systems that see what humans cannot see. The AI's conclusion might be wrong. The 5.3% scenario might occur, but the AI's conclusion is based on data you don't have, processed with capabilities you don't possess, identifying patterns you cannot detect. The information asymmetry between those who saw the prediction and those who didn't is the widest it has ever been. The institutions are on one side, the retail investors are on the other. The AI's assessment sits between them, shared with the connected, hidden from the rest. Exit everything is not investment advice. It's the action that connected institutions took when they saw what the AI calculated. It's the behavior visible in Form 4 filings, in hedge fund liquidations, in the 147-to-1 insider selling ratio. The phrase describes what happened, not what should happen. The institutions exited. Their exit is documented. Their reasoning, the 94.7% confidence prediction, has leaked. What you do with that information is your decision. The AI made its calculation. The institutions made theirs. The 60-day window continues counting down. 55 days remain. The prediction stands at 94.7% confidence. The institutions have acted. The asymmetry of information that always existed between Wall Street and Main Street has widened into something unprecedented. An AI prediction that moves billions sits available to those with connections and invisible to those without. Until now. The fragment leaked. The screenshot circulated. The prediction is no longer secret. What was hidden is visible. What was asymmetric is now shared. What the AI calculated, you now know. The remaining question is simple. Do you believe the AI, or do you believe that markets always work out? The institutions answered that question with $31 billion in liquidations. The insiders answered with 147-to-1 selling ratios. The BRICS block answered with accelerated alternative infrastructure. Everyone who saw the prediction answered the same way. Exit. Everyone except those who didn't see it. Until now. 55 days. 94.7% confidence. The prediction exists. The window closes. The AI spoke. The question is whether anyone listens.